Hi, I'm Steve Brice, Standard Chartered's Global Chief Investment Officer. Markets have continued to push to new highs in September, thus far defying concerns about seasonal weakness. Most major asset classes delivered positive returns, supported by easing trade tensions, ongoing optimism around AI, and expectations for further US interest rate cuts. Both the S&P 500 and Nasdaq recorded their strongest September performance in 15 years as investor enthusiasm continues to build around innovation, economic resilience, and supportive monetary policies. The macroeconomic and market developments have unfolded broadly in line with our projections outlined in the H2 outlook. US economic growth has shown signs of slowing, particularly in the labour market, prompting the Fed to initiate Fed rate cuts. We expect the Fed to cut interest rates twice again in the rest of this year and then 2 times in 2026, bringing policy rates closer to its own estimate of a more neutral rate, around 3%. The continued reduction in US interest rates means downward pressure on the US dollar is likely to resume. Our Signature CIO strategies have benefited from this supportive backdrop, delivering double-digit returns to date for our risk-based strategies, with global equities being the key driver of performance. One key question we're getting is, will the US government shutdown impact markets? Now, our base case is for a brief shutdown of approximately 2 to 3 weeks. We believe this would have limited impact on growth and corporate earnings, with US equities likely to remain relatively resilient. However, should the shutdown become more prolonged, heightened uncertainty could drive increased fears about consumer spending weakness and increased market volatility. Of course, in such a scenario, we would expect the Fed to move promptly to ease interest rates and support the economy. Now, given this backdrop, how are we positioned today? Well, we remain overweight global equities relative to both bonds and cash, supported by recent macroeconomic data and clear policy signals. We believe the forthcoming Fed rate cuts are likely to facilitate a soft landing for the US economy. This, combined with policy easing in other major economies, including fiscal stimulus in Germany and China, underpins our positive outlook for earnings growth. Within equities, we've upgraded US equities to overweight and remain overweight Asia ex-Japan. For the US, resilient earnings and monetary easing are expected to continue providing support. Meanwhile, Asia ex-Japan stands to benefit from a weaker dollar and improving earnings momentum. On the bond side, we see value in non-US dollar bonds, especially in emerging markets, where rate cuts can also offer additional tailwinds. Additionally, we have increased our gold allocation as diversification demand continues to rise. Looking ahead, the markets are entering the fourth quarter amid significant uncertainty. But the key takeaway is clear. Time in the market and staying invested matters more than trying to time the market. Sitting on the sidelines risks missing out on further gains, and as always, diversification remains your first line of defense. Thanks for joining me for this monthly Signature CIO strategy update. I'll be back with more updates soon. I look forward to seeing you then.